Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories within business filings. And let me tell you, this latest report from Terra Innovatum Global NV is a wild ride, a story of nuclear dreams, big business deals, and some seriously complex finances. Strap in because we are about to break it all down. So what is Terra Innovatum Global NV all about? Imagine a company building small nuclear reactors called Solo for clean energy everywhere. We are talking about delivering power wherever it is needed with reactors that can run for 15 years without refueling and are designed for maximum safety. They aim to be commercially ready by 2028, making these reactors using parts that are already available, which should make things easier with regulators. This filing is an amendment to their registration statement, which means they are making changes or additions to the initial plan. Maybe they learned something new or decided to adjust their strategy. This is normal for companies going public or making big offering changes. They've been busy after a big business combination with GSR Third Acquisition Corp. Back in October 2025, this is where things get interesting because a lot of the shares being registered are for reselling by existing shareholders. Not for the company itself, they are bringing in up to 5,475,593 ordinary shares from warrants and a massive 948,04436 ordinary shares from existing shareholders. This is a big number of shares hitting the market. Can sometimes shake up the stock price. Let's look at who is selling these 94 million ordinary shares. It's a mix of people like the sponsor holders who are early investors, management holders who are part of the company's leadership, and advisor holders who helped with the business deal. They also have about 40,200,000 ordinary shares coming from preferred shares that will convert eventually. The company itself doesn't get money from these resales, only from when warrants are exercised for cash, which could bring in about $595 million. But here is the crucial part: all these shares being sold by existing owners could really push down the stock price, even if the company is doing great, because there is just more supply. Their shares are traded on the Nasdaq under the ticker NKLR as of the 5th of December 2025. The price was $5.9. This is a key piece of information for investors because it gives a current market value to the shares being discussed. Now for the scary but important part, the risks, this part is always a must read. They admit up front they have incurred losses and have not generated any revenue. They expect to keep losing money for a while. This is a big deal for any investor. The whole solo reactor concept is not yet commercialized, meaning it has not been sold or proven in the real world. They also point out that managing growth effectively is a big challenge. This is a direct quote, and it really puts the financial situation into perspective. They have had operating losses and accumulated deficits. So far, they are relying on equity financing, meaning they are selling pieces of the company to raise money, which can dilute existing shareholders. This is another blunt statement saying it's hard to predict how they will do because they are so new and in a fast-changing industry. Imagine trying to guess the future of a brand new technology with no track record. It is a very risky bet. This is the heart of the current risk. They have not sold their main product. The solo reactor, there is no guarantee they will be able to sell it or make money from it. Their hopes are pinned on reaching binding agreements with customers. But those agreements are not yet set in stone. This is a huge gamble. Growing a company is hard, especially one trying to build complex nuclear reactors. They need to hire, train, upgrade systems, and basically build an entire operation. There is no guarantee they can do this successfully or on time. This means the company relies heavily on a few specific people. Losing even one of them could be a major problem for the company. This is a common risk for smaller companies and startups. Sprolway are part of the nuclear power industry, which is highly regulated. The nuclear industry is packed with rules and regulations. This is a good thing for safety, but it can also make things slow and expensive. The solo reactor is a new design, and getting approval from places like the US Nuclear Regulatory Commission could take a lot of time and money, and there is no guarantee they will get it. Nuclear power has a big challenge with storing and getting rid of old nuclear fuel. This problem could scare away customers if they think the risks and costs are too high for them. Even though Terra is selling the reactor, not operating it, this problem affects their potential customers. Like almost every company today, they are worried about cyber attacks, and in nuclear power, if these systems are breached, the consequences could be severe, not just for business, but for safety and regulation. This is a very serious statement from the auditors. They are saying there is a real question about whether the company can even stay in business without more money. This is a huge red flag for any potential investor. Since they operate in Italy and deal with euros but report in US dollars, they are exposed to changes in currency exchange rates. A stronger dollar could make their euro earnings worth less in dollar terms. Let's dive into the pro forma financials. This shows what the company might look like after all the recent deals are done. Imagine a snapshot of the company right after the business combination. And other major events, for example, their cash and cash equivalents are listed as $109,291,000. That might sound like a lot, but remember this is after combining everything. Notice the cash and investments held in trust account line, which shows $88,541,000. This is money set aside for specific purposes, typically related to the SPAC process and when shareholders redeem shares. Now for the harsh reality, the accumulated deficit shows a whopping $491,157,000 negative number. This is the total of all their past losses minus any profits, and a minus $491 million deficit is substantial. Looking at their pro forma statement of operations for the first 9 months of 2025, we see a total operating expenses of $11,730,000. That means they spent over $11 million just to run the business during this period. And the bottom line net income loss shows a loss of $10,685,000, so they are losing over $10 million in about 9 months combined with their other numbers. This paints a clear picture of a company that is burning a lot of cash with no revenue yet. The general and administrative expenses alone are $11,486,000. This is over $11 million spent on running the company from an administrative perspective, which is a massive chunk given they have no revenue. The net loss attributable to Pubco ordinary shareholders is a staggering $17,138,000. That is about $17 million lost just for this period alone. This highlights the shares held by the sponsor holders. These are often founder shares with special voting rights or conditions attached to them. Is a note showing 5,750,000 Class B shares outstanding, which are a key part of the original deal structure. When we scan down the list of selling shareholders, we see some very large holdings like Ning SRL holding 69,360,000 shares. This is over 44% of the company, and shows where much of the initial ownership lies. This section lays out how these selling shareholders plan to unload their shares. They can sell them on the stock market, or in private deals any broker involved could be seen as an underwriter, meaning they are helping to sell the shares like a traditional IPO, but the key takeaway is it's up to the sellers, when and how they sell their stock. Here they describe their stock. They have ordinary shares and preferred shares like most companies. The preferred shares have some complex conversion rules tied to company performance and stock price goals. Basically, they might convert to ordinary shares later if certain targets are hit. Let's look at the leadership team. They have a mix of executives and independent directors. This is pretty standard, though it is noted that one independent director recently resigned, and they are working to fill that spot. The CEO, Alessandro Petruzzi, has a deep background in nuclear engineering and safety. He sounds like a highly qualified expert in this specialized field, which is essential for a company like this. Let's check out who owns the most stock. Ning SRL is a major holder with 444% of the shares. This means a significant portion of the company is controlled by this entity, and their leaders Alessandro Petruzzi and Marco Cherubini also stand out as significant owners and key figures in the company. Now, for what the auditors have to say, Malone Bailey LLP signed off on the financials. They noted that the company has a going concern issue, meaning there is doubt its ability to keep operating. This is a recurring theme and a very important warning. Looking at the actual financials for GSR the third before it merged, we see that as of the 30th of September 2025, they had cash and investments held in trust of over $238 million. That sounds like a lot, but remember this is money from shareholders intended for finding and completing a business deal, not for general operations. Their accumulated deficit as of the 30th of September 2025 was over $11 million. This means the SPAC side of the business also lost money before the merger. Their statement of operations for the 9 months ending the 30th of September 2025 shows net income of over $34 million. But this is primarily from interest earned on the trust account money, not from actual business operations. The non-redeemable shares had a loss per share of $0.02. The company was a blank check company, meaning its whole purpose was to find and merge with another company. They didn't have operations until the merger, and the trust account money was meant for that specific purpose. Now let's look at the combined entity's balance sheet post-merger on the 30th of September 2025. Their total assets are only $3,748,000, meaning about $37 million. This is after combining everything, and it mostly comes from cash and some equipment. Their accounts payable shows $3,708,000, which is about $37 million. This is money they owe for services and supplies. It is a significant liability for a company with so few assets. The accumulated deficit here is $5,617,000, or about $56 million. This is the combined losses of the merged entities after the deal. It still shows they are operating at a loss. In their combined statement of operations for the third quarter of 2025, total operating expenses were $2,290,000, or about $23 million. Remember, this is for just 3 months, and the net loss for that same 3-month period was $29,87,000, meaning almost $3 million lost in just 3 months. Their total comprehensive loss for the 9 months ending the 30th of September 2025 was $5,612,000 or $56 million. That is a lot of money being spent. Looking at how their equity changed, we see a big increase in additional paid-in capital from 0 to 14,002,000. This is likely from the funding deals and the merger itself. However, the accumulated deficit jumped from negative $37,000 to negative $5,617,000. Their cash flow show they used $3,688,000 in operating activities in the first 9 months of 2025. This means they are spending more than they are bringing in, which is expected for a startup, but still a key point. This section explains Terra Innovatum Global NV was formed to become the parent company after the merger with GSR Third. The original Terra Innovatum SRL is now a subsidiary. This is a common structure for SPAC mergers. The auditors reconfirmed the going concern doubt for Terra Innovatum Global SRL. Before the merger, they state that about $56 million in losses and negative cash flow were seen. This is a major warning sign for investors about the company's financial stability. After the merger, a lot of bridge loans were converted into ordinary shares and warrants. This is a good sign that debt is being converted into equity, but it also means more shares are now outstanding. This confirms the merger happened in October 2025. Their shares started trading on Nasdaq under NKLR. On the 10th of October 2025, the company issued a huge number of ordinary shares, over 70 million, and received PIPE proceeds, meaning money from private investors in a private placement. This part talks about all the costs associated with this filing and the offering. And frankly, it is just a placeholder section listing estimates for fees and expenses. It is not where the real story is. This section details private sales before the merger, like the PIPE financing and bridge loans. These are important because they show how the company raised money before going public and how those deals structured into the current situation. This is a list of all the supporting documents like the merger agreement and other contracts. It is like the appendix of their entire financial story, listing all the evidence behind the reported numbers. So what is the overall picture here is my take. Terra Innovatum is a company with a bold vision, a potentially revolutionary product, and a very, very high risk profile. They are still in the very early stages with no venue and significant doubts about their ability to ever become profitable. The merger and listing are major milestones, but the road ahead is incredibly challenging. The sheer amount of cash they are burning and the fact that they are still pre-generating revenue means this is a high risk, high reward investment. The biggest strengths are their innovative technology and the strong expertise of their leadership team. Their nuclear reactor design has some very compelling safety and modularity features that could be game changers. The biggest risks are their lack of revenue, the extremely long and uncertain path to commercialization, regulatory hurdles, and the sheer capital intensity of this industry. They need a lot more money, and success is far from guaranteed. They are essentially betting the farm on solo becoming the next big thing in energy, and investors are betting on that bet paying off. It is a fascinating story, but one that demands extreme caution and a deep understanding of the risks involved. What are your thoughts on Terra Innovatum and the nuclear energy sector? Are you excited about small modular reactors, or do the risks outweigh the potential rewards? Let me know in the comments below. If you found this dive into Terra Innovatum's filing helpful, please give this video a thumbs up and subscribe for more corporate deep dives. Also, make sure to join our Discord community linked in the description for more discussions and direct insights into these filings. Thanks for watching. See you next time.